right, hello everybody. This is Anthony from Traders Ultimate Edge. It is January 27th. Had a fun day here today. We had a couple of trades. Our first one was a short right here. You can see this divergence here in the volume indicator as well as the fast line coming down, crossing south of the average. Really kind of gave us a heads up as to this trade. And then you can also see here, been playing around finding confluence with the MACD and the rest of our indicators that also crossed down right here. So this is just a really nice technical trade, and also breaking this trend line. You can see right here. There was another one. Our second short of the day was right over here, and we entered over here on this one. You can see we kind of peaked here on the volume indicator, started to pull back down. The average solidly in the bear territory here, so a lot of bears out. Well, I guess we already knew that, huh? And you can see here the fast line starting to move down. Same look on the MACD down here, and stayed in the trade up here because we formed a lower high, kind of a double top look, and then it fell, and we were able to get our profits. So those were our two trades here today, 2 day trades anyway. Overall, the market here today had another huge swing. We went from let's see, high of 44.22 all the way down to a low of 42.94, nearly a 3% intraday swing. In fact, that actually, I think that is 3% intraday swing, ending the day down quite a bit, down actually only down 0.4%. That's not too bad for the ES. The NQ got wrecked though. The NQ is down 1.2%. Dow actually up. So you can clearly see here, and if you look at this difference between SPY-G and SPY-V, it's the SPY Growth ETF versus SPY Value ETF. You can clearly see a continuing rotation out of growth and into value, which is a lot of what we were doing personally today. We had pretty long discussions on great additions to our long-term portfolios, and I've mostly finished adding in. I still have a bunch of cash left over, but just waiting to see if we pull down lower. As far as where the market will go, let me delete a couple of these lines, see a little easier. As far as where the market will go, it feels very weak to me. It is now underneath this trend line. You see this trend line here. That's where it rejected off of this morning, just below that 200-day SMA. Now, this trend line we can obviously see in play, so you're going to want to get that one on your charts. That was made just over the last few days. So you can see it starts from the low January 24, and it goes to today's high. And you can see it did have a couple of hits here a couple days ago, and then it broke hard through it yesterday after the FOMC meeting. So that's one that's definitely going to be in play, and it's one that we should keep our eyes on. Yeah, so again, as far how low is it going to go, right? Well, we've got this low back here from the 24th. That's down at 42.12-ish. I definitely believe it retests that. I have no doubts. You see, because we bounced back down off this trend line in such a hard rejection, I really have no doubts that we're going to test that area. I wouldn't be surprised if we opened the day down somewhere in that area, maybe around this 42.60 area. I wouldn't be surprised if we had a gap down. And then what I'd like to see after, if we gap down tomorrow, I'd like to see maybe an initial pullback real hard off the bell, nail that 42.12 area, and a bounce up from there. And that should give us a setup for the day tomorrow. Definitely looking to trade bearish tomorrow as of right now, looking for maybe a risk off into the weekend. So if we can get that initial real hard pullback in the morning tomorrow, and then a bounce up through up towards lunch maybe, and then I think we'll get a real nice pullback as we come to the end of the day as people risk off for the weekend. So that's kind of my thoughts there for tomorrow, and I think we'll get a really nice setup. Overall, I mean, as far as the market goes, people have asked me, how low is this thing going to go? Well, I'm just going to show you one thing here real quick, and maybe this will answer your question. Was this? Okay. Come with me. A trip back in time. Sorry, my chart is a little difficult to read, but I'm sure you can figure it out. Okay, right back here. This is April 1st of 2021, last year, and this was where the market crossed, gapped up over 4,000. Okay, this area was never retested. The 4,000 level was never retested. It got close here, 4,028, but it didn't actually touch 4,000. That's one of those really big, really important, really round numbers, and it never actually retested it. So my thoughts are, over the next couple of months, I can definitely see this ranging between, I mean, maybe even as high as 46, as low as that 42, maybe 41 area, until we get the FOMC minutes. When the FOMC minutes from this meeting come out, if they're bad, if they're super bearish, right? If it looks like it's going to even, sorry, my chart's so messy. If it looks like it's going to be even more aggressive than what they were saying in the meeting, and the meeting was as vague could possibly be. If it's worse than what they were talking about in the meeting, I could see us retesting that. I really could, that 4,000 area. I don't think it goes beyond that. But I could see just like this beeline right down to it, hit it, massive hammer candle up off of it, and that's the bottom. I could see it happening because the markets never did it. It's been, it's been almost a year. Now we're a couple months shy of a year. It would not surprise me to see that in the next month or so. Probably right after FOMC minutes if those are terrible. But in the meantime, we could range back up towards 4,600. And just kind of sit in this whole area. I've drawn out these fibs right here. This was the fib from January 12 all the way down to Jan 24. And I could really see it ranging in this area down here. I don't think it goes anywhere over the close from the last Fed day, which is right up here. It's 4,700. I do not believe it goes back over that. Not anytime soon. Because now, keep in mind, the markets have changed. We no longer have access to all this easy money, and that's what's been propping the markets up for so long. It's what has been fueling this this just unearthly rally in growth since coronavirus. It's been easy money, and now that the easy money is gone, the markets have to readjust to fundamentals. And this is why I tell everybody, learn your fundamentals. I like you can ask my clients. I harp on this constantly. Learn stock fundamentals. And this is why, because now, I'll put it this way. One of the accounts that I manage, it's a multi-million-dollar account. The markets pulled back. They were around like they're actually about 10% right now. They're around like 8.2 or something earlier in the day when I did this calculation. That account only lost 4.2% because I only invest in stocks that are very good values. I do not buy those massive growth stocks that are really extended, and that's the difference right there. That's why you have to learn fundamentals. You have to learn how to value stocks right, and you have to learn when to enter those stocks. And you've got all these funds out there that have just been so massively leveraged into these growth names. I mean, ARK is a great example. ARKK, it's a great example. When that fund came out, I said this will eventually crash. It's going to bubble and it's going to crash. And guess what happened? It bubbled and it's crashing. Because it's been invested in those names that were the hot stock of the week. The story stocks that didn't make any money. That's nearly all that was in that portfolio. And there's so many managers out there that did the same thing. It's like during the .com bubble. There was so many managers out there that invested all of their firm's money into whoever had the best domain name. Pets.com, houses.com, whatever, right? Whatever .com. And look what happened. I mean, in hindsight, that's pretty predictable. Just like really extended growth stocks with an EV to sales of 200 plus was really inevitable and predictable that they were going to crash. So that's where we are now. And now the market has to readjust from that paradigm of easy money, which, I mean, we all knew wasn't going to last forever, but it has to readjust from the paradigm of easy money. And start to look forward to real macroeconomics. It has to look forward to real good valued companies, companies that really have earnings, companies that have good leadership, companies that have just great financial situations, that don't burn through capital, that don't have tons of debt. They have to now shift the way that they're looking at things. And I think as that happens, we're going to continue to see this volatility. I think that's a lot of the reason that we're seeing the volatility. So keep in mind, like I was just talking about, these fund managers, okay, that have leveraged billions and billions of dollars into these stocks. They can't just exit the position all of a sudden, right? If there's a 5 million share sale on some mega cap, that's going to drastically drop the stock value, right? So funds can't do that. That's why they have things called dark pools, where they can go and they can buy and sell amongst themselves, and it's not reported until the next day usually. That's why they can, or that's why they do it slowly. So you see what happened here overnight. Asia sold us down and continued this sell-off. London came in right here, 1 o'clock my time, and started to push us up, right? And then we got some really good economic data, actually. The GDP data looked really good, and it pushed us up even higher. And all of a sudden we sold off. Well, why did we sell off? Was it bad news? No, there wasn't bad news. The market popped back up, and all of these fund managers that are sitting on, thousands of shares of, insert stupidly high growth name here, we're trying to get out of those positions desperately before their whole careers get ruined, right? That's what we're looking at right now. And the rest of us just kind of sitting on the sidelines. I mean, we can take advantage of it. I've bought a couple of growth companies now, and generally I don't. But a couple of them are really good valuations. A couple, I think, NVIDIA and Microsoft were two that I think are really good valuations here. NVIDIA might fall further. It may go further. So leg into that one. But a couple ideas for you. Anyway, that's my take on the market right now. We're going to keep seeing this volatility. Every big pop up is going to, I believe, is going to sell off because of that fact, because there's a lot of people trying to change their portfolio compositions due to the changing paradigm in the markets. So that's all I've got for you guys. I hope you have a great evening, and I hope you make a whole bunch of money, become millionaires tomorrow. All right, bye-bye.